Hello, my name is Paul Pavia, and I am a manager in the Healthcare and Human Services Group at Feeley Driscoll in Boston, Massachusetts. On this webcast, I will discuss the importance of internal audits, specifically the development of an annual risk assessment and audit plan. For more information on this topic or other topics, please visit our website at www.fdcpa.com or contact us at 888-875-9770. Historic healthcare reform has become a reality over the past few years. Pressures to reduce costs, changes away from traditional reimbursement methods, shrinking profit margins, advancements in information technology, increased mergers and acquisitions, and evolution toward a more customer-focused approach have altered existing risks and created a whole new set of risks. A strong internal audit function can keep existing risks in check and enable organizations to properly respond to new risks before they become an issue. The current healthcare landscape is subject to greater regulatory scrutiny, necessitating a high-level approach to risk management. The development of an annual risk assessment and audit plan is one method to achieve a high-level risk management process and ensure the achievement of internal audit goals. The annual audit plan is a report of scheduled audits by process or location that is developed each year based on results from the Audit Universe Risk Assessment. The Audit Universe is a list of auditable processes, functions, activities, or information technology functions and units within the organization. The risk assessment results and the annual audit plan are presented to senior management for comment and input prior to review and approval by the audit committee acting on behalf of the board of directors. The internal audit risk assessment focuses on exposure relating to governance, operations, and information systems, including the effectiveness and efficiency of operations, reliability and integrity of financial and operational information, safeguarding of assets, compliance with rules, regulations, and laws. The annual risk assessment takes into consideration a variety of factors, such as risks and concerns communicated by management in response to daily normal activities, internal concerns communicated by management and staff throughout the year, risks and concerns identified during compliance planning, design assessment, and testing, audits that were planned for the current year but will not be completed due to time or staffing, functions and processes of which the organization benefits from routine review, such as cash receipts, travel expenses, and other areas of potential abuse, the last date the unit, function, or process was audited, current trends that have an expected impact on the organization's future performance, and concerns communicated by external auditors. The results of the annual risk assessment are used to indicate which internal audits can be scheduled for the upcoming year and which internal audits will not receive adequate attention. Before these audits are determined, buy-in should be obtained from senior management, the audit committee, and the board of directors to enhance transparency and mutually agree upon the best use of organization-wide resources. When developing an annual risk assessment, a four-step approach can be used. The audit universe consists of potential processes, transactions, activities, information technology applications, and business units. 2. Define risk categories. Examples of risk categories include control framework, change in business environment, governance and management oversight, compliance with policies, regulations, and laws, asset transaction liquidity, complexity of process, technology functionality, and information technology system dependency. 3. Perform risk ranking on the risk categories by assessing inherent risks. The inherent risk for each category should be assigned a weight from 1 for low risk to 5 for high risk. As an example, I will use the risk category information technology system dependency. A weight of 1 for low risk means that the process, activity, or transaction is minimally dependent on IT. A weight of 3 for medium risk means that the process, activity, or transaction is moderately dependent on IT, such that unavailability of IT would hinder critical business operations. A weight of 5 for high risk means that the process, activity, or transaction is highly dependent on IT, such that unavailability of IT would stop all normal business operations. 4. Develop an internal audit plan. Based on the annual risk assessment, as well as input from management, internal auditors, and the board of directors, an audit plan can be developed to best focus the organization's resources on those areas that are most risky. Internal auditing activity is generally conducted as one or more discrete assignments, and the scope of each may vary depending on various factors, including risk, objective, geography, unforeseen occurrences, and change. The scope, generally full or limited in nature, will determine the procedures used to develop the audit plan. A full scope audit plan involves 7 steps. 1. Establish and communicate the scope and objectives for the audit to appropriate management. 2. Develop an understanding of the business area under review. This includes objectives, measurements, and key transaction types. This involves a review of documents and interviews. Flowcharts and narratives may be created if necessary. 3. Describe the key risks facing the business activities within the scope of the audit. 4. Identify management practices used to ensure each key risk is properly controlled and monitored. 5. Develop and execute a risk-based sampling and testing approach to determine whether the most important management controls are operating as intended. 6. Report issues and challenges identified and negotiate action plans with management to address the problems. 7. Follow up on reported findings at appropriate intervals. Internal auditors maintain a follow-up database for this purpose. A limited scope audit plan generally involves the same 7 steps, but at a scaled-down approach in response to available resources and the course of action chosen during the annual risk assessment. Depending on the size and needs of your organization, the resources available for internal audits will differ. In general, large organizations often have the available resources to operate a fully staffed internal audit group, whereas smaller organizations often have less available resources and must rely on outsourcing. Before an organization can determine a level of outsourcing that is appropriate, several considerations such as size, current operations, available resources, and complexity of the organization must be reviewed by management. The optimal solution for each organization may also change over time as the variables that influence the evaluation change periodically. In cases where total outsourcing is selected, often for smaller organizations with less available resources, oversight and responsibility for the internal audit cannot be outsourced. An in-house liaison, such as a senior management employee, should be responsible for the internal audit. Consideration must be given to the independence of both the external auditors and the in-house liaison. The board of directors or those charged with governance should be involved in the approval and oversight of the internal audit. In any instance, appropriate research should be conducted in order to evaluate legal considerations related to outsourcing engagements. When considering any level of outsourcing, an analysis of the advantages and disadvantages should be conducted. Common considerations include independence, professional standards, qualification of the service provider, staffing, flexibility, availability of resources, experience, reputation, familiarity with the organization, culture, coverage of multiple locations, communication, and cost. I hope this summary of internal audits was useful to you and your organization. As the healthcare climate changes, so will the methods that an organization takes to address existing and new risks. Effective annual risk assessment and audit plans can aid an organization in preemptively identifying and responding to potential areas of risk that could negatively impact the organization, both financially and operationally. Those organizations with robust risk management systems will be in a better position to respond to uncertainty with an effective system of internal controls. Again, I am Paul Pavia, a manager in the Healthcare and Human Services Group at Feeley Driscoll in Boston, Massachusetts. Thank you for your time, and should you have any additional questions, please feel free to contact us at 888-875-9770 or visit us on the web at www.fdcpa.com.